we're going to basically talk about three things that we think are important to look at in real estate today. One is that the capital markets are recovering. The second is that fundamentals are recovering. And the third is that the government is supporting policies that are going to help protect real estate assets on a long-term basis. And maybe most importantly, if we end up in a period of high inflation, real estate may be one of the best stores of value. So let me start with the presentation. And so the three things that REITs have going for themselves today. Let's first talk about valuations. I don't like starting with valuations because I think it kind of it assumes the answer as to what's happening. But the global REIT benchmark, and these numbers are as of basically mid-year, the global REIT benchmark is up 50% from its bottom. That bottom was reached in the first quarter of 2009. But it's still 60, maybe now 55% below its peak valuation level. From a cap rate perspective, everybody's pretty much familiar with what a cap rate is. Cap rates are today significantly higher than they have been for multiple years. So I would tell you that the public listed property market, unlike the private real estate markets, including those in Australia, have corrected. And an 8.5% to 9% yield, when we see U.S. Treasury rates on a 10-year basis at 350, is quite attractive. Third thing is from a valuation perspective, and we'll get into this in a minute, it very much looks like what has happened here in the last 2 or 3 years will be almost a direct repeat of what happened in the U.S. REIT market in the early 1990s. And it's amazing to me that the public REIT market in the early 1990s, both in Australia and in the US, the public market tends to lead the private market by about 12 to 18 months. Well, in 1990, in the third quarter of 1990, the public REIT market bottomed in the exact same time period that the private market peaked. So people get confused by, well, why is there this low correlation when they all own real estate? Well, the reality is that public ownership is impacted by public shareholders who dictate the price and push it up and down. So we're going to make an argument here that the public market, which has sold off significantly over the last couple of years, has already baked in expectations for a drop in fundamentals, drop in rental rates, a drop in occupancy levels, and an increase in cap rates. From a balance sheet perspective, there's been a lot in the news media recently about REITs, A-REITs, REITs in the UK, in the US, and to some extent also in Europe, issuing equity in a very dilutive basis. A lot of the REITs right now are having significant trouble because the value of their property has come down, and they have mortgages that they cannot refinance because the credit markets for real estate have been hurt significantly. So what the real estate companies have done that are public is they have issued significant amounts of equity. It's been dilutive, it's been painful because it's hurt NAV for the long term, but it's also significantly taken the solvency and the liquidity risks of the REIT market, which were one of the primary reasons that REITs sold off 65, 70%. Was liquidity risks. Those risks seem to be off the table today. We'll talk a minute also about the fact that REITs are one of the few participants, listed property companies are one of the few participants in the real estate industry today that have access to capital to fund tenant improvement costs, and they're also in a very, very good position to make accretive acquisitions. So, third, the outlook for real estate. Let me give a broad perspective on what we think is happening in the property markets globally. First, we start with the perspective on the world. I think that most economists and the economists that we heard today would agree that China is growing. Asia, or ex-Japan, is growing. Frankly, Australia is going to grow as an economy. So we feel very good in ranking the world economies from China, maybe perhaps down to Japan, with the UK and the Eurozone slightly below the US in terms of long-term expectation for growth. That's kind of the big macro trend. What's happening also is that the listed property markets are going to be in a secular favor. And what I mean by that is as follows. In the United States, for the last 4 years, private equity funds, closed-end funds, have been using excess leverage to go and buy real estate at exceedingly ridiculous prices. As a result, most vintage funds in 2005 through 2007 are underwater, meaning that all of the equity is wiped out. The investors, the pension funds, the institutions who funded those business models don't have liquidity. Whether it be in closed-end funds or whether it be in open-end funds, a lack of liquidity in the private equity market is one of the key reasons that we think the listed property market is going to take off in the future. So we expect to see a big secular shift where investors now will favor publicly traded real estate companies over private equity real estate companies. And there's a couple significant reasons why that might happen. One is liquidity. Second, transparency. People want to know what they own. Third is fees. One of the primary reasons that the private equity market got flooded with deals at high leverage is that investors were paying 1.5 and 20. Very high fees in the private equity market. The public equity market has a more attractive fee schedule. On a forward-looking basis, the lack of debt capital in the market today is going to favor public real estate ownership relative to private equity ownership. In the public REIT market, REITs were actually, throughout most of the developed world, net sellers of real estate in 2005 through 2008, when this big feeding frenzy of purchase activity took place. The REITs, who typically end up averaging 40 to 50% leverage, could not compete with the private equity purchasers. In a world that we all believe is going to be delevered, the REIT model, which favors lower leverage because investors like ourselves end up selling public REITs when they have too much leverage, will come back in favor, and the closed-end funds that relied on 90% or 80% leverage are really going to be out of business. So there's a big secular shift here taking place that's going to favor the public REIT model for the foreseeable future. Macro expectations for the world. I think that everybody realizes now that when the market moved, and we talked about that in the last session, when the market moved, the money moved out of every region, whether it was a strong region or a weak region, a good property or a bad property, the money moved out simultaneously. Every asset sold off. And I don't know that we can get away from that happening again. But I can tell you that at this point in time, with the markets having sold off, and there has been a recovery, the recovery is going to be focused on those global property markets with better long-term growth prospects. China, for instance. We have investments in China. We have investments in Hong Kong. The Hong Kong real estate developers, the Chinese residential developers are performing quite well, up over 50% year to date. They are volatile, but that is where the growth is. From a fundamental market perspective in the United States, in Europe, in the UK, there's significant problems. The problems in the UK are largely one of significant supply and very, very weak demand. In the US, it's a demand-led problem. And we think that we may only be in the 5th inning, that's out of 9 innings of baseball, in terms of where we think fundamentals, in terms of supply, in terms of demand for property, rental rates, occupancy levels may end up falling to. So our thesis that now is an attractive time to invest in real estate is not without the assumption that things are going to get bad, and things are going to continue to be bad in the fundamental market. But we think that there's this secular trend in the listed property market is actually going to be a bigger offset than the weakness in the fundamentals. As a listed property company, you have access to equity capital. And the equity capital that was raised in the last several years is quite significant. In the last, several quarters is quite significant. In the US, $17 billion of capital was raised in a period of about 6 weeks. In the US, in Australia, there's been about $15 billion of capital raised. In the UK, about $6 to $7 billion of capital raised. In no other area of the real estate market can you raise that kind of capital so quickly. In the US, there have been 21 attempts to raise rescue capital for closed-end funds. This is privately held partnerships who are potentially going to file bankruptcy. Big, big funds that may file bankruptcy. Only 2 of those funds have actually successfully raised rescue capital. The listed property market had quite the opposite reaction. With 40 or 50 or 60 transactions completed, the average return in the 1 day following the issuance of additional equity was over 5%. So the market for listed property shares is actually quite robust today. The US is up over 20% year to date. Australia is up year to date. Japan is up. So we're going to show you some of the return numbers, but it might be surprising to learn that the listed property market is not only performing well, but it's performing well in the face of private real estate markets performing quite badly. From an overall investor perspective, again, I think, I can't make the point enough that the best time to invest is when no one else is willing to. So here's a demonstration of what happened to cap rates, which is basically the inverse of the PE ratio for private real estate. Cap rates for private real estate fell during this big feeding frenzy of credit that was available. It basically meant that the yield on real estate assets went down. Since that point in time, they're rising. Well, that's an appropriate reaction. It doesn't mean that the model for real estate is entirely broken. It meant that the pricing model was broken. If we look at how bad the credit market for private real estate got, this is just in the US, this is the commercial mortgage-backed securities market. And you can see in 2005, 6, 7, the amount of capital that went in to the CMBS market was really unprecedented. And that really drove the cap rate compression that took place here. So too much capital fueled a drop in yields. This is not a broken market. This is actual supply and demand working. We may not like the results, but it's working. Do we need a new model? No. Capital markets work when left alone. We may not like the volatility, but capital markets do work when they're left alone. So here's a chart of the US REIT secondary market. This is the equity that's been raised. So in the absence of capital forming in the debt market, capital is actually forming in the equity market. And so our expectation is that the equity market will continue to delever for private real estate and for public real estate. And as a result, there's going to be a much more stable environment going forward. There's going to be lower yield expectations. I frankly think that people's lofty yield expectations for 10 and 12 and 13 and 14% long-term return expectations, particularly in the US, were one of the reasons that people levered up. So we all got on the bandwagon of using too much leverage at the wrong time. The REIT market in the US, with this level of equity issuance, it's just the beginning. So we're expecting to see significant equity be raised on a longer-term basis. If you look at valuations in the listed property market around the world, you can see that the UK, which is top left, fallen significantly. The US valuations have fallen significantly. Hong Kong office markets have been volatile for years, and Australia is actually performing well. We like Australia. It's one of our most favorite developed nations in terms of investing for real estate. We like the listed property market here. We like the long-term association with China and growth. So we're pretty comfortable and very happy about investing in Australia. If we look at the world's listed property markets, where is it? Where is this $21.7 trillion of real estate located? Well, it's in the markets that you would expect. It's in North America, it's in Asia, it's in Europe, and the rest of the world is emerging. The argument that I don't like against being negative forever is I just saw on the TV this morning an advertisement for Malaysia. Okay, come to Malaysia, come work in Malaysia or vacation in Malaysia. There's 600 million people in Malaysia. There's only 350 million in the US. Okay, so people seem to have forgotten the big macro trend here that there's a lot of people living very much below the means who want to have more, who want to shop for the first time. And it may not be that they're going to be shopping in the US, because you're right, the US consumer doesn't have any more money. My wife does, but the rest of the consumers don't seem to. So as India and China and people in Malaysia, okay, and these populations grow, they're accumulating wealth and they want to join the middle class. This is the reason that the economies of the world are going to continue to grow. And to focus too heavily on the US, I think, is a mistake. We think the US will not be the big engine of growth that it once was. But that's okay. It's a global world, and we're global investors, and we're going to find great opportunities to invest. If we look at the global REIT market in terms of its volatility, in terms of where it's gone and where it comes, unfortunately, this is just what I was saying before. From point A to point B, it's always volatile. But let's look at some of the return numbers. In the early 1990s, we had the same issue, a big pricing problem that took place. Too much leverage was used. At the same time, there was too much development, particularly in the US. We don't have a big development problem in most of Europe, in most of the US, in Japan, in Australia. There's not too much supply. So this time, I think that the recovery rate could actually take place relatively quickly. After the 1990 to 1992 time period, the REIT market did extraordinarily well. This is a global REIT market. We had the Asian crisis, and REITs performed basically for a period of almost 4 years with almost no return. And then we had a period basically of strong returns as technology spending and frankly, too much leverage fueled the next period of growth. And now we're back in the red. So we're not out. The REIT market and the real estate market, I think in the US, most institutions in the US have this feeling that investing in real estate is something that they're afraid to do again because it was too levered. And the reality is that now may be one of the best times to begin investing again because the yields are so high. If you're looking for yield and you're looking for growth, you have to remember that while all markets came down together, various markets are coming back differently. And in Hong Kong, in Singapore, you're seeing year-to-date returns that are perhaps outsized. I'd be a little concerned of jumping on that bandwagon today, but maybe in a couple months we'll see some values come back and we'll get into there. But there has been very much of a mirror image. The markets that fell the most in 2008 came back the most in 2009. The markets that fell the most in 2009 have come back in the second half of 2009. So there is a decoupling that's happening globally. The repeat effect of listed property. I was reading in one of the super fund magazines. There was a guy on the cover talking about the valuation gap for real estate in the August issue. And this is effectively what he's referring to. Private real estate prices are falling, and they're going to continue to fall. And they're going to continue to fall because appraisers who value real estate have to look at transactions. And there really aren't that many transactions to look at. And the ones that people can look at may be either distressed, so therefore they shouldn't be used for comparison, or we just don't want to look at them because there's too few transactions. The public market has already priced it in. And if we look at what's happened to listed property markets since 2007, look what's happened to the listed property markets, the gold line. They've sold off significantly. But the non-listed markets have performed exceedingly well. Why? For two reasons. A, the REIT market overreacted to the downside, and secondly, the private market underreacted to the upside. So it's the appraisal smoothing that takes place. So if you come back and talk to your board members and say, well, I'm thinking about maybe we should look at real estate again, the headline risk for real estate is going to be bad. There's going to be more front page articles on occupancy levels falling, on rental rates falling, and on valuations falling in the private real estate market. The listed property market, however, is quite different. And the secular trend toward listed property is going to give it a big advantage. So, REITs versus private real estate. I think the listed property market, the benefits of the listed property market have largely been taken advantage of, or taken advantage for. meaning that people aren't paying enough attention to the fact that liquidity matters and transparency does matter. We think that trend's going to reverse itself. Investors in direct real estate are discovering that if they want and need liquidity, they can't get it at any price today because there's just a lack of transactions taking place. So we think that the listed property market is going to end up having a pretty big premium associated with it in the future for providing liquidity. Things that we're still questioning, maybe I'll focus on a couple things. How's the US going to get itself out of the problem? We don't like to say it too publicly, but what's going to happen? We're going to basically take 4.5 million undocumented workers and we're going to convert them to citizens so that they pay taxes, so that they buy homes, and they contribute to productive society. I don't like to say that with a cynical view, it's just reality. That's the way the US is going to grow itself out of the problem. We're going to allow immigration to be legalized. What else are we going to do? The Federal Reserve won't tell you that they're going to inflate their way out of the problem, but we're going to inflate our way out of the problem. Just like every other market may be inflating their way out of the problem. And as long as China has a need to maintain some degree of parity with the US dollar, it's not going to matter from a currency perspective quite to the extent that, that perhaps the other speakers were referring to. So inflation, if you're looking for inflation protection, where are you going to get it? You're going to get it by owning real estate. The cost of building buildings is not going to go down. The cost of commodities only went down for a short period of time and is now almost back up to where it was before. They're not making any more land. Real estate is going to be potentially a source of protection against inflation. We pay a lot of attention to which regions are going to emerge. We pay a lot of attention to the capital markets. And I think that we all just have to have lower return expectations. We can't expect all of our financial assets to generate 10, 11, 12% returns, particularly in a low yield, low growth environment. So the market that's going to shape up is going to be using less leverage, and it's going to favor the REIT market, the listed property market, and it's going to favor less leverage. The companies that we like. Let me skip ahead to what are we looking for in the listed property companies that we own. Most of them have gone through a fairly significant period of raising capital at very cheap prices, and it's been terribly dilutive. And they did it because they had to prove that they were going to survive. They needed that proof of life statement to the marketplace. As a consequence, they are very afraid to go spend a lot of money and lever up again. But they want to grow. They want to take advantage of distressed buying opportunities. Well, there is a transaction market beginning to develop for $30 and $40 million assets. There is no transactions market today for $3 and $4 billion transactions. So unless the REIT, but the REIT market has one thing it can do. The REIT market is going to issue equity to buy assets that are in distress. And the reason they're going to preserve the strength in their balance sheet today is because they want to show the likes of Hilton that got bought out at a big discount and will go public again, that perhaps Starwood, which owns this hotel or manages this hotel, that they're the best place for Hilton to sell into. So the listed property companies, after a period of significant decline, are going to be issuing equity on an accretive basis and growing their net asset values. They will probably not, over the next foreseeable number of years, be able to make up for all the dilution that did take place, but these accretive acquisitions are going to build on themselves. And you're going to see net asset value numbers begin to tick up after a period of time because of acquisitions. So we're looking for companies that have really clean balance sheets, that have management teams who have experience buying distressed assets, and at the same time, we're looking for companies who will protect their balance sheets, most importantly, when they're issuing shares. Last piece that we're looking for is really cheap companies. Companies where the intrinsic value of the company is preserved and is significant, and where companies are trading at a big discount to net asset value. So let me wrap up briefly. I know we spent a lot of time talking about the secular trend toward listed property. And that's because I know that the fundamentals are bad, and they're going to continue to get bad. But if you recognize that the public market and the private real estate market vary and don't always act like they're on top of one another, then you can take advantage of buying in the best cycle. In the 5 years after the REIT market bottomed and the private market peaked, returns for the private market were basically zero, and for the listed market, they averaged over 20% a year. So I'm not suggesting that'll happen exactly this time, but they do decouple over a period. So happy to take questions. I know that Doug's going to want me to wrap up.